I'll give a snapshot of Australia, which has got the largest gambling per capita in the world. There's around $30 billion lost just in Australia each year. And of that 30 billion, around 1 billion is lost on sports betting, 2 billion is lost on horse racing, and then $27 billion is lost on pokies, other casino games, and lottery.
Hey everyone, this is Prashant and I'll be your host for the VC 10x podcast. And today we have Tom Waterhouse with us. Tom is the founder of Waterhouse VC, a wholesale fund that specializes in investments in the gaming and wagering industry. Tom comes from a long line of bookmakers dating back 4 generations. The Waterhouse family has been the forefront of the wagering industry for over 100 years. In this episode, we talk about how does the gambling industry work, how does the money flow in the gambling industry, regulations in the gambling industry, the tech side of gambling, the 3 pillars of asset management at Waterhouse VC, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10x, where I help VCs start and run their own podcast. While I was running VC 10x, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Tom, so good to have you on the VC 10X podcast. How are you doing?
Great, thanks, Prashant. Thanks for having me on.
Yeah, it's a pleasure having you on. To start things off, can we have your story to start with?
Yeah, look, so I run a Waterhouse VC, which is a venture capital firm, been going for the last 5 years, and it focuses on the gambling industry, investing in suppliers, so technology suppliers to the gambling industry. Gambling industry is obviously a $1 trillion industry, but we think that it's under-researched and underlooked at the suppliers to it. So everyone sort of understands the operators, the likes of FanDuel, DraftKings, Caesars, William Hill, Entain, but the suppliers of technology to those businesses, they're not all listed, but those companies have thousands of technology suppliers, from data feeds to platform providers, to mobile development teams, to voice betting solutions. And we look at that technology. And the background to how I came into VC, I don't know if you want me to talk, Prashant, onto why I'm in this industry and why I focus on that. That probably is more of a... Yeah, so
that'd be good.
The reason being is my family's been in the gambling industry for over 100 years. So my great-grandfather was a bookmaker, taking bets at the horse races in the 1800s. My grandfather was a bookmaker. My dad was a bookmaker, and he's run a professional betting syndicate, betting on horse racing for the last 44 years. And then straight out of university, I became a bookie at the greyhounds, the dogs, and at the horses. By 2008, really because I had a blueprint of what to do from my grandfather and my dad, I was the largest bookmaker in Australia, and it was a terrific business. I thought I'd be doing that forever. But what happened is that the internet really took off in terms of the iPhone came out, there was 3G, and the advertising restrictions got lifted for online betting. So what was a great business, being an on-course bookmaker, suddenly went downhill very quickly. So I launched a an online betting business called tomwaterhouse.com. It was the fastest growing online betting business in Australia, but we didn't have the scale to compete with the global giants that came into Australia, like uh, Paddy Power, which now is Flutter, William Hill, Bet365, and so on. So we sold, there was a $700 million roll up of several businesses in Australia, and we were a small add on as part of those acquisitions, and sold a business in 2013. In 2014, they asked me to be the CEO of that company. So I ran that business for them in Australia for 4 years. When that was sold to PokerStars in 2018, I had a 2 year non compete. And I thought, well, where's the edge in the industry? And I thought, well, the edge is really in these suppliers. And the reason being the edge was there, some of the reasons I mentioned to you, but really is that the last 10 years has been increasing taxation, regulation on the big operators, and the suppliers, they're less understood, but they also take a clip of gross revenue and don't have the same exposure to taxation and regulation and restrictions as the operators do. And that was really the beginnings of Waterhouse VC.
Absolutely. That's a very interesting story, and you have a strong background in this space, kind of born into it, right? And for people who are not very familiar with the gambling space or the betting space, it's a massive industry, like you said. But can you give some more context about what is gambling in practice? You gave some examples about betting on horse races and things like that. What are some other examples of that?
Yeah, so like I'll give a snapshot of Australia, which has got the largest gambling per capita in the world. There's around $30 billion lost just in Australia each year, and of that 30 billion, around 1 billion is lost on sports betting, 2 billion is lost on horse racing, and then $27 billion is lost on pokies, other casino games, and lottery. Now, Australia is a unique market in a sense in that it doesn't allow any online gaming and it doesn't allow any in-play sports betting. But the market is really the majority of loss comes from gaming in the space globally, and sports betting and racing are still large. There's a lot of money lost on those things, but it's really online gaming, online slots, live dealer, blackjack, these type of things are where the main losses are. And then there's obviously new types of gaming when you look at video gaming and loot boxes. Our fund focuses predominantly on tech suppliers to sports betting and racing operators rather than online gaming or video gaming. Well, it's not to say we don't look at tech suppliers in that space, but we have a real core area of competencies in the area of sports betting and horse racing.
Absolutely, that's quite interesting. And what are all the different stakeholders in the betting and the wagering space, right? So there are people who are making the bets, then they are the service providers or bookies who are taking
Correct.
those bets in a way, right? So tell
So
us about all the different stakeholders involved here. Yeah.
yeah, so you have the largest operators in the world, listed operators in the world are the likes of Flutter, which owns FanDuel, DraftKings, Caesars, Entain, MGM. You've got unlisted operators like Bet365, Stake, uh, and then those operators. So traditionally, bookmakers were either high street bookmakers in the UK or they were monopoly operators like the Tabcorp in Australia or the Hong Kong Jockey Club in Hong Kong. Or they were on course bookmakers. They didn't come from a technology first background. And so, what is surprising is that uh, most or many of these operators don't own their betting engine, so they outsource it to a third party. So, like the largest betting engine operator is a company called OpenBet, which is owned by Endeavour. Uh, they outsourced a lot of their mobile app development. They outsource their odds feed. So, when you bet on an NBA game, that feed comes from a company called Sports Radar or Genius Sports. When you bet on a racing event, that data comes from SIS or a company called BetMakers or a company called Racing and Sports. When you bet on casino games like Live Dealer, you're betting with even though you might be betting with Caesars or FanDuel or whatever, that provider, the technology provider, is a company called Evolution, which is a listed company on the Swedish stock exchange, or Playtech, which is another listed company in the UK. So really, these bookmakers, they own the brand, they own the database, but there's a lot of underlying third-party tech which powers the gambling industry, and that's where our fund is focused on. I'll go into the different pillars of our fund when you want me to, but our focus is really on that technology layer because the average person in the street doesn't actually realize that these large operators that they have their bet with, they think that they've put the odds up and provided all the technology and the underlying technologies all in house. They've got huge development teams, and don't get me wrong, they're technologically savvy, but there's a lot of third party tech that powers their what they provide to the customer. And
Right.
I think just one
Yep.
thing to also add is that the last 10 years, obviously, you've seen the expansion of regulated sports betting and gambling in the US. PASPA was repealed in 2018, and you've now got half the US that offers online sports betting, and you've got sort of like 20% of the US, a bit less than 20% of the US that has online gaming. Um, but you've seen a regulation globally of online sports betting and gaming. So it's now getting more regulated. But what comes with regulation is taxation and restrictions on what you can offer and what you can do. And so the the ability to outperform the market is much harder in the regulated operators because they're facing increasing tax and increasing regulation on what they can do and offer customers. And so the margin to be had in that $1 trillion industry, we believe, and where our focus is on the technology suppliers. They're geographically diversified, and uh, they're also taking a percentage of the gross win rather than the net after all the taxes.
Right, right, right. That's quite interesting. So I'm in India right now. So it's actually a regulated place for betting. I don't think betting is allowed directly here, but there are big startups in this space which are not betting. Cannot call them as betting apps, but there are apps like Dream 11 or My
Yep.
11 Circle, many different apps here, which are mostly focused on cricket, fantasy team building, right? Uh, Another way of betting, but slightly different than that, I think. But they are also facing increased regulations and taxations from the government, right? So, which aligns with what you're saying. India might be a difficult market for
Well,
such companies.
Well, obviously India is an amazing market in
Mm-hmm.
so many different ways, and it's a very interesting market from the gambling perspective because obviously you've got such a large population, but you're also an amazing nation in terms of how much you love sport. Like cricket
Right.
is huge globally, and
Yep.
a lot of the global turnover on cricket comes from people in India wanting to bet. The regulated, obviously, you've got some regulation like that you can have some sort of skill-based gaming in India, and you've seen the likes of Flutter, which have made acquisitions in India in more a fantasy style product. But that's similar to the US. You build up customer database, large customer database, get them engaged, but get them betting on fantasy or different types of skill-based games, and then work with government to say, well, look, there's a lot of offshore leakage. There's a lot of, you can't tell me that Indians don't bet on the IPL or on international cricket. It's just, they do. You can't stop that leakage. And I think that the operators, they come in and they make strategic buys of companies that are offering fantasy and these type of things and get large databases, get scale, and try and lobby government as much as they can and say, look, this is the leakage. You're better off regulating, taxing, putting in harm minimization and player protection measures than having a large chunk of the population betting with illegal bookmakers, not having any problem gambling measures put in place to protect customers, making sure that people get paid, and also making sure the government gets good tax revenue from it. So I think India is a very exciting opportunity, and you wouldn't see the world's largest listed gambling operator like Flutter make entry into India if they didn't think that it's a possibility. It's and uh, yeah, I think that India is a very exciting market, and especially because India's is growing not only population wise but GDP wise, and like uh, how everyone's got smartphones now and internet is just amazing. It's there's probably not any more exciting country in the world. Well, US obviously is amazingly exciting. Still, you've got half the US to open up, but India is very, very exciting.
Yeah, totally. The internet penetration here is amazing, and that has been a key driving force even for fantasy app as well, because it is reaching the mass population, and they are able to take those bets or make their fantasy team whatever those apps are offering, and then make or lose money in that way, right? So that's very interesting. So as a VC in the space, who has a lot of experience in the space and has seen it all in a way. You have very strategically placed your focus on the tech side of the betting industry, the tech providers, because you feel that's where most of the money is made, right? So, can you help me understand how the money flows in the betting industry, right? So, firstly, there is someone placing the bet; they are putting down their money,
Yes.
and
Yep.
they're placing the
So
bet.
you
Yeah,
have $100 on the next
mm,
cricket match.
right.
Um, the operator uh, has to the operator let's say on average can win 5% on turnover. So you have $100 bet, on average he's going to win $5. Of that $5, he has to pay tax to the sporting body. He has to pay a regulatory tax, like a point of consumption tax or some other type of tax. So in New York, for instance, you're paying 52% of tax. In Australia, you're paying 40% of your gross profit. So of that $5, you're paying like $2.5 in tax. And then once you've got that gross, you're paying a percentage of that gross profit to your people that provide the data for cricket, or the people that provide your betting platform technology, or you're providing to whoever gives you that data feed. You're giving them a percentage of the gross. Then you're paying out of then you're paying your marketing costs, your headcount costs, your technology costs, all of the costs, and then you'll have something left after the $2.5. Then you pay your company tax, and then you obviously have your your profit after tax after that figure. So if you break it down as $100, you're paying, like, let's say, of $100 one off a customer, you're paying $40-50 in taxes. You're then paying maybe another $15 in fees to your tech providers, and then you're paying your headcount costs and all of the technology costs and marketing costs out of the last bit, and then hopefully you have enough uh, scale and operational leverage that you can have enough left. And that's the issue, as you've seen. And this is why we don't invest in operators. We steer clear of operators. As you've seen in the US, PASPA opened up, the largest economic nation in the world, and in 2018 in the US, and there's only been one operator that's had 1/4 of profitability since it opened up. So operators are fighting for scale. The largest two operators spend $1 billion each on marketing in the US because they know that to get to scale is so important. It's actually critical in a highly taxed and regulated market. And so for us, we don't want to be part of that. We think it's not to say that they're not amazing operators, and there's people that make money out of investing in those things, but we like being in the technology providers that have much larger margins than the operators.
Absolutely, I completely agree with that. Because what I see in India, also the top fantasy cricket apps that are there, they're spending very heavily on all the major leagues, and their ads are everywhere, like plastered everywhere. So they're spending huge money, and profitability, and the competition is very fierce. There are just so many apps out there trying to do the same thing and get people on their platform. So it's very hard to
I
do
think
that.
also is that if you're an analyst at a major bank,
Hmm.
you can understand how a betting operator works. Do you know what I mean? If you understand how, let's say, Entain works, you can understand how Flutter works, or you can understand how Caesars or MGM works. It's very similar lines of the P&L. They have X amount of customers that turn over a certain amount. They have a certain like win margin. They have cost of sales. They have these costs of doing businesses. It's analyzing whether one should be trading at 8 times or 12 times or 15 times earnings. A savvy analyst can do that far better than that's not my skill set. But what is much harder for someone that doesn't have the uh, experience in the industry and understand how it actually connects in the back end is understanding whether a technology provider to one of these operators, if they've got one contract, are they likely to be able to get 20 contracts? And how sticky are they in that gambling company's ecosystem? And that is where we have a unique skill set. Our team we've got some amazing engineers that have been building gambling apps and been involved in the industry for the last 10, 15 years. And we feel we understand that tech layer of the gambling space better than nearly anyone. And that's our skill set.
Right, totally. That's amazing. And can you tell us about some of the businesses that you're bagged and what exactly are they doing?
Yeah, yeah. Is it probably high level worthwhile telling you about how the fund operates? Is that, and then we can go into examples of each. If does that suit
Sure,
you?
sure,
Or
sure. Yeah,
so,
surely that works. Yeah.
so the fund has been going for 5 years, and we've had great success since we started. With 31 times our investors' money. We've compounded over 100% per annum year on year, and it really has all come down to the first pillar of our strategy. We've only got one fund, but we have three pillars to the strategy. The first pillar is that we find these technology providers that might be in India or it might be in Brazil or in Eastern Europe. We find these technology providers that are revenue generating, but generally only have a couple of contracts, maybe one or two contracts. And we find them and say, look, this has got a unique piece of tech that we think can go global. And we negotiate with them to buy an option for 3 years, but at an agreed strike price today. So we might say, look, we think your business is great. How much do you think it's worth? And they'll say, oh, we think it's worth $10 million. And we're like, okay, well, look, we'd like to buy an option to buy a 20% stake in your business at a $10 million valuation, but have a 3 year time frame. And what we're doing is trying to find businesses that we think that can go from being worth 10 million to go from having contracts maybe in Eastern Europe to having contracts in the US, Australia, Hong Kong, wherever, and they suddenly go from being worth 10 million, but if they can get 20 contracts, they're now worth 200 million. And 3 years, in 3 years, we then have a very valuable option in that business. So I'll give you an example. If you wanted to start Prashant bet.com, you go, look, I think India's taking off. I know heaps about cricket. I want to bet in India and I want to have my name, bookie brand, and I'm going to put up the odds on the IPL and international test cricket, and that's going to be my go. But I don't know how to build a betting platform. But I know how to be a bookmaker. I know how to get a lot of clients. You'll go to a technology provider, a betting platform provider, and you will say, look, can I use your off the shelf betting platform to have prashantbet.com? And they'll go, yeah, you can. And look, we'll waive the upfront fee. You can just have the platform. But you have to give us 15% of your gross profit, or you have to give us 25% of your gross profit if we manage all the trading for you. We do managed trading services. So that technology provider is getting 25% or 15% of whatever you make as a bookmaker gross, not what paying all the expenses gross. And these technology platforms, if they can get 20, 30, 40, 50, 100 clients, they're very good businesses because they don't have the downside risk. They're providing the same platform to lots of people and they're getting a clip of the gross revenue. You're taking all the risk of regulatory risk, paying the taxes, headcount costs, marketing costs. Anyway, we look at these type of businesses. We've optioned up quite a few of these businesses. We were approached Christmas Eve a year and 7 months ago from a business in Vietnam. And they'd done a token sale in 2018. They'd run out of money. And they said, well, look, we in need of money. Can you invest in our business? We're like, oh, look, don't know. It doesn't sound, haven't heard of you. Don't know if the technology is any good. Our head engineer looked at the technology and he said, look, Tom, what they've built is actually, for us to build in Australia would take us a long time and a lot of money. Maybe it's worthwhile optioning up that business if you can get a reasonable value. So we were able to buy an option at what we thought was a reasonable value, bought an option for 3 years. Um, we were able to buy that option, and they, off the back of announcing that we've done the deal with them, they were able to raise some money. And then within 5 months, they sold that business to someone that wanted to expand their technology business. And for our investors, they sold it 23 times what our option price was within 5 months. So we've done plenty of businesses that go nowhere. Do you know what I mean? It's not like we've got some crystal ball. Like there's so many duds, but we're not risking huge amounts of money to buy the option. And when we get it right, we get a huge upside because we're buying the option with the time value of obviously the benefit of the option. So that's pillar one of our strategy. We understand the space. We've got an engineering team that understands what we think understands the technology layer better than nearly anybody. And that's pillar one of our strategy.
Yeah,
Pillar
just
two,
just on that,
sorry, Prashant.
just on
Yeah.
that. Yeah, so buying an option is kind of an interesting approach, and haven't isn't something that I've heard of in the VC space. That you're buying an option to invest at a future date, if I'm getting
Yes,
it right, right?
correct.
So how does that work? So what is valuation at that point of time? What are you paying upfront to buy that option, right? So give us an insight of that.
So we negotiate with them in terms of what what they think is fair. They're putting normally a value that they are very excited about in terms of, but we're excited because we think that the time of the 3 years, if they can expand the business and the technology is good as we think it is, we think they're normally in a home market. Like they might be in, we optioned up an esports provider in Prague, for instance. We think, yeah, they've got a great product. We looked at all the esports providers around the world. We analyzed them. We spoke to uh, the people they had contracts with. We saw their uptimes, their service level agreements. We went and visited the businesses in Prague, looked at their models, spoke to the team, spoke to the esports leagues to get their thoughts on it. We're like, actually, these guys are great. They are happy to sell us an option at what they think is a good valuation. But we're like, well, actually, if they're the best technology in the space, we think they can be much, much bigger than this if people in Australia hear about them, people in America hear about them, people in Hong Kong hear about them. So for us, it's for them, they're happy if they go to the valuation we're buying the option at. And we basically saying, well, look, actually, if we find great technology and people globally hear about it and they can go from having 3 contracts to 20 contracts or 30 contracts, they're going to be far more valuable. And that's basically, we love the strategy because we risk very little at the beginning and we get the value if they come off. We get something that's very valuable if it comes off. And we believe that because of taxation and regulation in the operator area and advertising restrictions, the way that operators differentiate now is all about product, because advertising restrictions are getting tougher and tougher. How much do they differentiate on their Facebook ads or their Instagram ads or their TikTok ads or their influencers? Really, we believe that the big differentiator is all in product differentiation. So if we find the really great product that's doing something innovative and different, well, we think that their value, if we keep finding great ones and they can expand distribution, that we can find some great businesses, and that's sort of what we do.
Got it. So let's say a business is fundraising and they are on the lookout for, let's say, $250,000 for a 10% stake in their company, right?
We don't do that.
You don't do that.
We don't
So
do that. We option up businesses. We don't look to put because we believe that uh, like the majority of the businesses that we option up will not succeed, will not go to being our option being valuable. But a few of them, so like we've had over 5 years, 4 option deals come off, but we've looked at 16 businesses this week. We're progressing 5 businesses. The majority of businesses won't come off. Do you know what I mean? That you've got to, for that business to succeed, you've got to not only have the right business that a FanDuel or a DraftKings wants, but then you've got to get into their product roadmap, which they might have 500 products in the roadmap. And then you've got to get integrated, and then you've got to get distribution, and then you've got to get them to market it. So there's for us, it's highly speculative for us to just invest in lots and lots of them. Now there's groups, I'm sure, that do that very well. That's not our area of expertise. We want to, where, and you'll understand when you understand the other pillars of our fund, we're taking ultra low risk strategy, trying to get large return. So
Right.
we don't have any position in our fund over 5% of our fund. We're looking for very high return with very low risk, and that's basically what we try to do.
Right, that's an interesting approach. Does this buying an option work the same way how it works in the stock market?
Yeah. So
Oh,
we've option up businesses that are listed and unlisted. Yeah, it's
okay, got it, got it. Yeah, yeah. Go ahead.
so should I go on to the next few pillars in
Yeah,
this
yeah,
in the
sure, sure.
strategy?
Please. Yeah.
Okay, so we've had high return obviously over the last 5 years. We're a fixed unit trust in Australia. We distribute all of our gains every year and all of our dividends every year to our investors. So we don't really need a huge amount of money in the fund because we're optioning up businesses, and we only really need the funds when we're converting the option, and we're only converting the option when they're in the money. So there's not a huge need for much upfront capital, but our investors really like that we keep finding great option deals and we've got great return for them. So they have put money back into the fund with us over the time. And our second pillar is we were sitting on cash. We were like, well, we like our option strategy. We know this area. We feel better than anybody. We understand the space. We think it's got ultra long runway, high growth. Do we sit on term deposits, bonds, put the money into gold? What do we do with the cash? And what the family has done for the last 10 years, and the family is the majority of the fund, is we have followed a 13F strategy. So we've gone which funds have outperformed. Obviously, as you know, any fund that has over $100 million in equities has to release a 13F filing, which outlines all of their positions, what's been bought and sold, percentage of the portfolio, and so on. We went, well, what funds are long only, and what funds have beaten the S&P over the last 30 years consistently? We narrowed down to 16 funds that have beaten the S&P, that are long only, have long duration of their holds. So likes of Berkshire, Bridgewater, Third Point, Apollo, Tiger, and so on. We go through those 16 funds, 13F filings once a quarter, and then we apply a few proprietary factors. So trading under 20 times PE, growing revenue greater than 20% year on year for on average over the last 5 years, very little debt, and a few other factors. And we narrow down. Normally, it narrows down to 10, maybe maximum 20 positions, and then we evenly weight across those positions, and then we back test against how we go against just putting into an S&P 500 tracker like index fund. We've outperformed the index by 7.9%, with a Sharpe ratio of 1.07. Our average PE ratio is 13 times. The S&P is trading at, I don't know, 23, 24 times. Our median growth rate is 28%. Median growth rate of the S&P is 18%. So we're in what we believe is lower PE ratio companies with a higher growth rate, and average market cap 60 billion. So we sit, the majority of our fund, 98% of our fund sits in large cap US equities. So we went to our investors and said, look, we're parking all your money in large cap US equities. We're following these 16 funds, 13F filings. We're applying these proprietary factors. We've got 2 analysts doing it once a quarter, and we don't spend any time trying to pick companies. We don't have any opinion. We just want to follow the best funds in the world, and we want to park cash in what we believe are a conservative group of large cap US equities. And we're going to spend 99.999% of our time focusing on optioning up technology providers in the gambling space. When we need to convert an option, we will sell down, evenly weight sell down those US equities to convert the option if we have to. If you need your money, we have monthly redemption. So we have monthly in and out of the fund. If you need your money, it's sitting in highly liquid US equities. So you can get your money in and out every month. But we're not trying to pick the market. We're not, we just basically want to be exposed to the US equity market. If you're comfortable being exposed to the US equity market and you're comfortable being in a subset of what those 16 funds are doing, then you're comfortable with our strategy because the optioning up is less than 2% of the fund, but the optioning up provides all the alpha in the fund. So Pillar 2 is an ultra boring US equity strategy. And that's what Pillar 2 of the strategy is. Do you have any questions on that, or would you like me to go on to Pillar 3 of the strategy?
Yes, yes, you can, but that's mind blowing. One of the most intelligent strategies I've heard on the podcast. Yeah, go ahead.
Well, I might be not have it, but I think it'll be very hard for many US equity funds to outperform us because we're performing in line. Well, we're actually beating index since we started, but like maybe we don't count on beating it, but I think it's a conservative portfolio. We're going to perform in line with most good US equity strategies, but we're just going to have kicker after kicker. And I say to our investors, as long as you see deal flow, that we're constantly optioning up more and more businesses, you want to be in the fund. The minute we stop finding option deals, well, don't bother being in our fund because you can find lots of US equity strategies that can perform better than us or probably in line with us.
Right. Absolutely.
So pillar 3 of the strategy is that we have optioned up lots of businesses in the space, and one of the businesses that we optioned up was a professional betting syndicate. Now, nearly everyone loses betting. The reason being is that if you're betting on uh, India versus Pakistan in Test match, you might know that under certain conditions with certain players and the way that the wicket's playing, you might know that India is mispriced and they're over like the $1.70 or whatever is value. And you go, well, I'm going to have one bet on this test match, and that's my one bet a year, and you got it right. The bookies have mispriced it. Like they've got the price wrong. It should have been $1.50. They put up $1.70. You've backed India off the map. You've won a fortune backing India. India's won the test match and you've won, and the bookies have got it wrong, and you were clearly right, Prashant, on backing India. The issue is that every time you bet, if you do it all the time, the bookies, they don't know what the true odds of India versus Pakistan are, but they build in margin on each side. And so if you're betting all the time, you've got that margin against you. And so it becomes, for someone that bets as a recreation entertainment, it becomes sort of like you're betting on a casino game because the house edges against you all the time. So someone can win if they bet one off where they've got clear insight or thought about it and the bookie's got it wrong. There's no doubt that they can win. But if they bet, like the average better that bets regularly bets 60 bets a week. Now, for that person that bets all the time, they're doing it as entertainment and the margin is against them. So it's virtually impossible for them to win betting all the time. So when people come to us and say that they can win betting, we either think that they're uh, delusional or they have had a period of positive variance and they're delusional, or they're con artists. But we don't think normally that they can win. Now there are groups around the world that win fortunes. So like Tony Bloom, the best soccer punter in the world, wins huge amounts of. He's been given an MBE by the King. He owns Brighton Football Club. He employs 1,600 analysts. He can win hundreds of millions of pounds betting on soccer. You've got the largest racing syndicates in the world that are on the rich lists of their different countries. So there are people that can win because they look at it like a Jim Simmons or whatever in terms of crunching thousands of factors into a model to work out what the true probability is to beat the market. But they have huge teams and they're ultra switched on, and it's very few and far between. Anyway, my dad has run a professional syndicate for the last 44 years, betting around the world on horse racing. So I have a little bit of background understanding it. One of our investors said, look, there's this tennis bettor that's betting that's unbeatable, a young guy. You've got to meet him. And so I went and met him, and I was blown away. I was like, this guy's ultra impressive. Um, his background, he'd worked for Tony Bloom. I called Tony Bloom and I said, look, what what do you make of this guy? And he goes, look, he's exceptional. Unfortunately, he's left us to go out on his own, but he's an exceptional young man, amazing ability. We optioned up his business, and he has able to triple turnover and gross win every year for the last 3 years, betting on tennis. And we converted a stake of a 10% uh, profit share of his syndicate, his tennis syndicate. Um, so we believe he is the leading tennis bettor in the world. Got a huge runway. He's expanded to now he has 23 analysts. He's expanded into women's tennis as well. And we have, as a fund, have a 10% profit share in his tennis syndicate. That's a dividend. So our investors get a dividend from his tennis syndicate. Um, uh, we have also optioned up two other syndicates as well. Converted one option in another syndicate. We get a profit share from that. So we get a dividend play from these syndicates. So our strategy has three pillars. The first pillar gives us all the capital gain or capital uplift when the options come off. The second pillar is capital preservation. We hold in large cap US equities. We get a very small, like sub 2% dividend from that. So the investors are sticking capital preservation pillar two, and they get a small dividend, which gets distributed to them each year. And then the third pillar, they get a quarterly dividend from other syndicates that we own a profit share in, and that gets distributed to them each year. So basically, uh, they 98% of the funds sit in US equities. We get a dividend from our syndicates, and they're relying on us to find option deals to get large capital uplift, finding option deals in the technology space in the gambling sector. And that's the three pillars to our fund. And basically, we've been going for the last 5 years, and myself and the team just have our head down, going to every gambling conference we can around the world, trying to find um, great technology providers. And it's funny. I say to my dad, I said to him, I was at this conference in Rio because Brazil's just opened up gambling. They've got 130 operators that have applied for a license there, and I said to my dad, I go, look, it's like going to a school dance, and none of the blokes have turned up. You've just got all the pretty girls at the school dance, and it's a little bit like that for us in that there's all these technology providers, but there's no other VC funds looking at the technology providers. They're looking at the operators. And so we believe we have a unique area that we focus on that no one else or no other funds are really focusing on. And that's where we want to basically just keep our head down and keep doing that and yeah, focus on the area we know.
Totally. That's a very interesting and a very intelligent strategy of the three pillars you just mentioned. Great to learn that, and good things for me to learn as well about the approach. And is this really venture capital investing? Because venture capital investing is particularly thought of to be done in a certain way that you're buying off equities and you're putting a price tag on the company and you're buying a particular stake. That's what is called traditionally venture capital, right? Do you think
Prashant,
that it fits? Yeah,
my background as a bookie. I just bought the URL Waterhouse VC. I don't know if it's technically venture capital or what it is. I just know it works. So I
yeah,
don't know. For me,
yeah,
it's like I just love the strategy in that basically we don't have US equity exposure of over 5% in a company. We are in large cap, ultra low PE, conservative businesses, and we just keep focusing on the one area that we know, and we think we're getting options at what we believe are good value. So
right.
yeah, whether it's technically venture capital or what it is, I don't know, but it's
Yeah.
yeah. My
Yeah,
background is not finance. My background is just betting, but
right.
I think this is a unique way and the best way from a return point of view to play the sector
Yep.
because obviously I've been in the sector all my life. The other areas, being an operator is much tougher now.
Mm-hmm. Totally agree. And good thing is that our podcast is now diversified into different areas of investing. We are also doing some private equity episode. We are also just about to do an episode on hedge funds. So we're pretty diversified, and this certainly incorporates the kind of investing you're doing, which is very unique and probably doesn't fall into a specific bucket, but is very unique. And I hope it reaps great returns for you, which I think it would, given the strategy, right? Awesome. And last question for you before we go to the rapid fire round. And this is, what's been your biggest learning as an entrepreneur over the years, building these businesses that you now pass on to the people you invest in?
Oh, and this is sort of carried through to why we went into this strategy is that TomWaterhouse.com, I thought I would be a bookie forever. And I thought that I could build TomWaterhouse.com to being the largest bookmaker in Australia. Now I might be deluded, obviously I was. But there were so many, we were offered 10 times what we sold it for a year before we sold it. And there were so many factors, internal, but also stack of them external, that impacted that valuation and impacted the outcome. There was luck, there was taxation, there was regulation, there was a whole bunch of competitors, what they did. There was different customer things. There was different technology change of what came out technology wise, like mobile ramped up significantly. We created a desktop website. There was just stuff that happened that impacted the outcome. And and the team worked so hard, but there was a way that the business could have been sold for nothing. We got a good outcome, and we could have got an amazing outcome. And it was all out of control. And I sort of see that with an operational business is that it's always changing. A great business can become a not a good business very quickly, and or vice versa. And I sort of two things. The first is that you always want to be able to be nimble and let your revenue lead your costs so you can pivot quickly. But I love that our strategy is you say, well, I mentioned to you before, so many of the businesses we option up don't go anywhere. And the ones that actually go great, I wouldn't have guessed that they were the ones that went great. Do you know what I mean? That business that I mentioned in Vietnam, I flicked that onto our CTO. I didn't even give it the time of day. He's the genius. I had no idea that would, you know what I mean? If I had to list out of 50 different deals, I would have gone, well, that's, so you just don't know. And so I love where you're spreading your bets across, you're not all in on something, you're spreading your bets and you're letting your winners really work for you and you're not getting hit when there's plenty of losers, and that's, and yeah, there's just so much stuff that can happen that is outside of your control.
Right, totally agree on that. Now let's go to the rapid fire round wherein I'll ask you five quick questions about the investing you're doing, and you have to give five quick answers, right? So the first one goes, what are the sectors and regions you invest in?
Oh, so we only focus on technology like GamblingTech, and mainly focus on sports betting and racing. And regions, it can be any regions because gambling is global. So, for instance, we're a technology provider, let's say a voice betting solution. Now, that voice betting solution can get contracts with uh, fantasy operator in India, Brazilian operator, UK operator, Hong Kong Jockey Club, Australian operators. So it can be anywhere. So for us, it's a global, um, we're looking from a global point of view, but we focus really on the one sector.
Absolutely. And at what stage in the business are you interested?
For us, we only want to focus on businesses that are at least generating some revenue because
Hmm.
we've found that at the idea stage, there's so much to go from the idea stage to actually getting money flowing through your hands. There's so much execution risk, and ideas sound amazing, and uh, we don't want to be part of the rah rah hockey stick excitement of the idea. We want to be in the negotiating the option when they're like, actually, gosh, it was hard to get that one client, and there's so many problems with that one client, and to get the money through the door with this, and they're actually in the real thick of. That's where we want to be.
Right, right, totally. And what's the initial investment you put in?
Well, that just varies in terms of
Okay.
how much we negotiate to buy the option, but uh, uh, we try for as little as possible.
Hmm.
Um,
How little, like from the data you have, from the investing you've done, give us a range on that.
oh, so we've the the least we've paid for an option is sub $1,000, and the
Hmm.
most we've paid to convert an option is 17 million. So
Okay.
yeah, so it's a big range.
Right, right, totally. Great. And where can founders of these businesses get in touch with you and maybe apply for funding in case there's a direct way?
So waterhousevc.com, if anyone's got some great piece of tech or wants to look at um, uh, like us, we would love to know about what they're doing and understand what they're doing.
Awesome. Where can our listeners follow you?
Look, we have a newsletter that we send out each month on what we find interesting in the sector. And if you just go and you can sign up to our newsletter on the website waterhousevc.com. There's a ability to sign up, and you'll get our like monthly newsletter on the space. And you can see all our past newsletters on the website also.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Tom. It's been an amazing conversation and a very insightful one. And I wish you happy investing.
Oh, thanks, Prashant. Yeah, good to chat. Bye bye.